Thank you and good evening, everybody. Thank you for taking a few minutes tonight to listen to a little snippet of information about Burford. It's very nice for me to see so many familiar faces here. I've come to shares for a number of years now, and I wanted to come back this year after Burford has continued to have a reasonable degree of success that I'll walk through with you. Just to say thank you to those early investors who gave us your support. I was reminded today, Chris and I were just talking about this, Chris who runs shares, when I first presented at a shares conference, Burford stock was trading at 131p. Today it closed at 1410p, so a 972% increment. And if we were ranking Burford on the FTSE, we'd be about 137th today. So that has represented for us a remarkable degree of growth. And that is because we are taking advantage of a leadership position in a very interesting and rapidly growing sector, which is the provision of capital to the legal sector. And I'm going to walk you through a little bit about what we do. You have from us a slide deck that was accompanying our annual results, which came out not all that long ago. That deck is too long and too detailed for me to walk through it with you in 20 minutes. And my past experience with shares suggests that people at these presentations often have a considerable number of questions. And so I am actually going to try to keep myself even below that 20-minute mark and leave time for people to focus the discussion in the way that they want. And my caveat, of course, is that I'm Canadian, but I have lived in New York for a long time. I used to be an American trial lawyer, so for a year, and ultimately the Global General Counsel of Time Warner, the media group, so I was paid by the hour to talk for a long time. So if I don't do that for you, you're in grave jeopardy of the evening disappearing before you. So I'm going to show you a couple of slides first. This slide that's up on the screen right now is effectively history. And the reason I say that it's history, even though it's our current earnings, is that Burford is a provider of capital into the legal sector. We put capital against the underlying asset value of legal claims. And I'll come back to what that means in a little more definition, but all of you have all of the information and all of the knowledge just by living in the world that you need to understand the basics of what goes on in the legal profession. And one of the things that all of you know is that lawsuits take a long time. And so when we are showing results like the ones that you're seeing on the screen, significant increases in income, profit after tax, and cash receipts from the business, what those are reflecting are investment decisions that we made some time ago that then wend their way through the process and take some time to mature. So we have virtually nothing in our business on a current year basis. It's extremely rare for us to make an investment, let's say in January, February of a year, and to have that investment conclude and get the cash from it in the same year. So really this is a backwards looking indication of what has happened in the business over the last 9 years that we've been in operation, and you're seeing 5 years here of performance. And so we're obviously pleased that the business has been able to grow at this kind of rate and to continue to produce the kind of returns that we're generating. Last year, the return on equity spiked up a little bit, as you saw there, but we've always historically been generating private equity style, fairly desirable returns on equity. The business is a dividend payor, and we have increased the rate of dividend payment in every single year of our existence. To be fair, this is not a high income stock, and the reason for that is because we have significant demand for our capital. Part of the way we satisfy that demand is by reinvesting the capital in the business. And candidly, we're getting higher returns on those dollars or on those pounds of reinvested capital than in most cases you would be getting from taking the dividends out of the business. And so rather than paying high dividends and borrowing, we are recycling some of that capital in the business. But nonetheless, we pay a steady and a rising dividend. So I said that that slide was history. This slide is really more about the future. And this slide is just showing you some basic numbers about what has happened to Burford over the last few years, and in particular, what happened in 2017. And what you see, starting with that box on the top left, is the volume of new investment business that we wrote in 2017. And as you can see, that went up very significantly. So what we're seeing is a market that we started to open, we really started to pioneer as an institutional matter not quite 10 years ago. And that market was slow to develop, and now what you're seeing is the fruits of those labors, in that demand has really turned a corner in the legal market that we're serving, and you see a significant increase in new business. That new business that we're writing in the current year is what sets us up for future earnings and future profits in the years to come because of that duration lag that I mentioned to you before. And when you look at the returns on investments that we generate, the portfolio on a gross basis, but net of losses, has spiked up a little bit there as well. We're generating 31% IRRs, 75% returns on invested capital from the capital investments that we're putting out the door. So with that, let me take a step back and just explain very briefly for those of you who are new to this, what it is that we're doing in the first place and why this business even exists. So what Burford does is provide capital into the legal sector. All of you are familiar with law firms. Most of you know that lawyers are quite happy to take your custom and to send you bills for their time by the hour, which they expect you to pay relatively rapidly. They're not taking risk, they're simply charging it their time. Now that's a perfectly good business model if you're a lawyer. Indeed, it generates for large law firms, which are my client base, it generates quite high operating margins. Law firms have operating margins that sort of start around 40% and go up from there. Many of you will know lawyers and know that they generally are able to lead somewhere between a comfortable and a more than comfortable existence from the compensation that they make off those hours that they charge you. But there is a challenge with that business model. And the challenge with that business model is that law firms don't have balance sheets. They're just cash partnerships. They don't generally access the capital markets. They're allowed to here in the UK, but you don't see very many of them doing that at all. And you certainly don't see any of the large and very profitable firms doing that. In other jurisdictions like the United States, the largest legal market in the world, they're actually not allowed to do that. They're actually precluded from accessing the capital markets. And so what you have is this dynamic of these profitable cash partnerships with law firm partners who are dividing up the earnings of those partnerships, but that don't have balance sheets and are unable to take risk and build a balance sheet without partners individually cutting their compensation, which, as you can imagine, is somewhat unpopular among lawyers. So what that means is that when you have a world where clients, corporate clients, become increasingly unhappy with the need to keep on paying huge legal bills by the hour, corporate clients start to push on the law firms to alter their business model, to take risk, to defer payment. And the reaction of the law firms is that even if they were willing as a conceptual matter to do that, they don't have the balance sheet ability to take on that kind of risk. And so what has emerged is an industry of providing capital into that division between clients and law firms. And Burford is the largest player in that industry. Think of this in no different a way than think of law firms as manufacturers, happy to sell their products for cash, but not wanting to run their own leasing book, wanting to outsource their leasing book to a financial partner. And that effectively is the role that we play in the legal industry. We are the outsourced leasing provider, if you will, for law firms when they have clients who want an atraditional model. So that's fundamentally what we do, and it's frankly no more complicated than that. We're a specialty finance firm. We do the same things that other specialty finance firms do. We have deep subject matter knowledge in our area of investment expertise. We do extensive due diligence on potential investments that come into us. And from that pool of potential investments, we make a selection of investments, we put capital behind them, and then we wait as they wend their way through the legal process, and we derive our returns from the operation of that legal process. There are, however, a few interesting investment attributes about investing in claims. To begin with, the operation of the legal process, which is what's driving our returns, is entirely uncorrelated to both the markets and economic conditions. When you start a piece of litigation, you're effectively pushing a button on a big conveyor belt, and it's starting to move forward. It may twist, it may turn, it may move at varying speeds, but it moves forward inexorably and it comes to an end. That end is the investment exit. We don't need to do anything to get to that exit. We don't need to find a buyer for an investment like a private equity or venture capital firm does. And there is no correlation attached to the timing of that exit. So we have an uncorrelated set of investments, and we are the beneficiaries of the fact that litigation resolves in various ways. And all of you, again, know this just from living in the world. There are three possible outcomes to any piece of litigation. Two of them are obvious to you sitting here. You can win, you can lose. The third, though, is by far the most common, and that is that the litigation will settle. And all of you see litigation settling around you all the time. The reason settlement is such an important financial dynamic as an investment matter is that settlements are both riskless. You've removed the litigation risk from the equation because the parties have agreed on the settlement. And they're generally cash flow positive. Because if you have a big claim against me and my best offer back to you to resolve that claim is zero, you're not going to settle. You're going to keep on litigating. So you're starting off from a proposition that out of a diversified portfolio of investments, many of those investments are going to resolve themselves before reaching the end of the litigation process. So they're going to resolve themselves risklessly and usually on a cash flow positive basis. And that's a very nice foundation to build this business on. Some number of you, in addition to owning the equity in Burford, own bonds that we have issued, public bonds that we've issued into the market. And Burford, even when it was a relatively young, nascent company, was successful in being able to issue bonds to investors because as a credit investor, people understood the relative lack of risk in the principal dollar portfolio. In other words, the question of equity upside here is uncertain, and that's for investors to determine. But the risk of a loss of principal dollars is a different matter, and that risk is relatively low because of that dynamic of litigation resolution, that a lot of litigation settles. And when litigation doesn't settle, it has an asymmetry in its resolution. In other words, when you lose a piece of litigation, you're losing the money that you invested only in the legal fees to try to win. But when you win, you're winning the damages that you claimed. And so when you combine those factors on a diversified basis, and you add together the impact of settlement and the impact of the asymmetry between wins and losses, you have a portfolio that is generally cash flow positive. And that's one of the underlying premises of this business. We are purely a corporate commercial large dollar player. We don't provide financing to consumers. This isn't an ambulance chasing slip or fall, slips and trips business. It would be rare for us to do less than a couple of million dollars, a couple of million pounds in an investment transaction. The average size of our investment transactions today is $24 million. So we're playing at the high end of the market, the corporate commercial end, generally speaking, with the very large global law firms. What you've seen reflected in our financial results has also been reflected in the broader market. So what's going on here, if you step back a little bit from Burford and think about what's going on in the legal world generally, there are a couple of dynamics at play, again, that all of you are going to be familiar with. One of them is there is a significant increase in regulatory compliance spending in the world. Many of you are painfully aware of that increase in regulation. The other thing that's going on in the world is an increase in the volume and cost of litigation. And one of the reasons for that increase is because of the predominance of digital communication. 20 years ago, you had a smaller footprint today for litigation purposes than you do now. Because today, I can get all of the keystrokes that you've taken, all the email that you've sent and received, all of the Bloomberg Messenger chats that you've made. Whereas 20 years ago, I could only get the pieces of paper that you had elected to save in manila folders outside your office. And that makes it more expensive to litigate. And it also means that companies face more litigation because it is possible to go and examine their history in a way that it wasn't possible to do before. And those are the drivers around corporate clients coming and wanting these solutions. And the graphs that you see in front of you are a reflection of that kind of fairly dramatic market change in a fairly short period of time. So the graph on the left is showing you market research data. And in a mere 4-year period, you've seen respondents report more than a quadrupling of demand in this market, with still quite a lot to go. And on the right-hand side, you see a very significant majority of respondents suggesting that they believe that there is growth here to come. This gives you a sense of the volume of activity that we're seeing in the market. So in 2017 alone, we had more than 1,500 separate investments come in the door looking for capital from us. And of that 1,500, by the time they made it through our multi-stage diligence process, complete with our proprietary risk modeling, we only closed 59 of them. That was enough for us to commit well over $1 billion of new capital. But that shows you the level of demand that is out there in the market today. So what that's led to is a very significant portfolio now, so that Burford's portfolio of invested capital between our balance sheet business and the investment funds that we run is around $2.5 billion. We have more dry powder available for investment today, and we're seeing significant demand in the market. And so these numbers give you a sense of the kind of scale the business has become. And the reason that's significant to you as an investor is really about diversification. You know, if you were brave enough to invest in Burford 10 years ago, you would have made a nice return on your equity, but you were taking a considerable amount of risk at that point because Burford did not have the scale at that point in its existence to have built a diversified portfolio like this. Today, you have instead considerable diversification so that no case capital loss, no investment capital loss on our portfolio would exceed 2% of our overall balance sheet. So that diversification is an enormous strength for us. It's also candidly a competitive advantage and represents a material barrier to entry in this business. And I have a lot more slides, but I promise to leave an extra amount of time for questions. I'm just going to finish on this one slide that gives you a snapshot of what we did just in 2017, and it shows you a little bit about the growth of the business and the lines of business that we engage in. So we started off largely financing individual pieces of litigation, single cases. Those single cases today, we still write lots of single case business, but on a relative basis, even though it's been going up in absolute dollars, on a relative basis, that's declined to be a single-digit percentage of the business that we do. Instead, the majority of the business that we do today is more diversified multi-case portfolios for both corporate clients and law firms. That's more than 50% of the new investments commitments that we wrote last year, and those provide an extra layer of risk diversification because of the fact that they include multiple cases in the same investment transaction. And so with that, let me stop, and realizing that that was a fairly brief and incomplete version of Burford, I'd suggest to you that you, if you're interested in some more information, not only flick through these slides, but read our annual report, which is actually, the one good thing about having a business run by litigation lawyers is that we know how much risk we can take. So that annual report is actually written in plain English for humans, as opposed to being just a formulaic disclosure document, and we actually get a lot of compliments about the fact that it explains the business pretty well to people. But with that, I'd be happy to have your questions.
Great. Okay. Any questions? Hands up, please. Gentleman over here, Chris, please.
Hi there. My name is James. I head up the equity desk at MB Capital. So buying and selling lots of shares like Burford Capital, which we've done very well from. I was just wondering, obviously you're dominating the field at the moment in sort of your industry. What are the barriers to entry for someone else coming in?
So it's an interesting question because there are a number, and we write about them at some length in the annual report, but I'll touch on a couple of them. One of the things is really about scale. So if you are a new entrant today, what are you? You are what we were a decade ago. You're a few lawyers who are coming along and saying, let's give this a try. And so you're going out to investors and you're saying, you should back us. And the investor response to that is to say, well, gee, you've never run money before, you don't have any track record. There are half a dozen players in the field that have extensive multi-year track records and run, 500 plus $1 million of capital, ranging up to the capital that we run. And you're not able to suggest that you're going to do better than those players, so why are we going to back you? And the reality is that when you look at capital flows into this business, they have, in the recent past, largely been going to established players, as opposed to seeding sort of first fund players with $25 million, because that just doesn't give you a large enough team or enough diversification. Sir. Sorry, I'm not in charge of the questions.
Okay. Hello. I invest in your retail bonds rather than the equities, but that's neither here nor there. When I started to do that, I read the stuff about what your business model was and picked up the single case part of the model. I'm interested in the development that you've made that was on your last slide. Could you explain in a bit more detail what one of the other
Absolutely.
items,
So portfolio finance is fun. So let me step back from the question just a little bit and give you the background for why this has evolved. The one challenge with single case finance, literally us putting capital behind one piece of litigation, is that we will sometimes lose. Litigation is inherently risky. There is idiosyncratic, unpredictable risk of outcomes. I don't know a single lawyer who will tell you that you've got better than a 75% chance of winning even a very strong case. Most cases start off being quoted in the sort of 60-40 range. So what that means is that if you're looking to only a single case for the recovery of your capital, you're going to lose some amount of the time. And in single cases, we lose 19% of the time, which is pretty good compared to passive litigation results. But that's still 19% of the capital that we're putting out the door is going away and not coming back. To overcome that level of loss, we have to charge quite a lot for the capital in the cases that succeed. To a point where some number of potential users of the capital would find that pricing unappealing. The average, just to throw some numbers around that, the average return on invested capital that we charge on a successful case in a single case financing is 96%, because we have to offset those losses. And so if you're my old firm, if you're Time Warner, you're going to say, well, gee, my cost of funds is 3%, paying you 96% is not all that appealing to me. So the way that we have dealt with that is we have said to a Time Warner, come and bring us a pool of cases. Not just one, but 5 or 10 or 20, and cross-collateralize them. So that if the first case, so we're giving you a fixed amount of money, we're looking for a return of that capital. If the first case loses, we get paid from the second case, and the third case, and the fourth case, and so on. And what that has enabled us to do is drive down the cost of capital to those clients because the loss rates are so different. The loss rates in the portfolio world are 3 or 4% instead of 19%. And that lets us hold the same level of net returns while lowering the price of capital to clients. And that's why that has been so popular. It also, for us, creates some operating efficiencies, some leverage, some economy of scale. Sir.
An offer to settle out of court, is there often conflict between you and your client?
There is not, because we are passive in these investment transactions. So you should think of this as a buy and hold strategy. We need to make an investment decision up front, but we are simply providing capital to either the client or the law firm. We're not becoming a participant in the litigation. So we're no different than an aircraft finance company that is giving an airline money to buy the plane, but once our money is in the plane, it's up to the pilot not to fly it into the side of the mountain. I'm not in the cockpit helping to steer. So we don't have any role to play in settlement. The only way we can affect the settlement dynamic is with the structure of our transactions at the outset, but we don't get a veto or a seat at the table.
Thank you. Gentleman here.
Hi, good evening. I've got about 30 grand's worth of shares at £4.50, so quite a few years ago now, and so we've done rather well at Burford, so thank you for that.
Thank you.
Frank question is, obviously you realised some of your gains a few months ago, 4 million shares. I think you've got another 4 mil left. Any insight on that? And second question is, obviously with the big, large German car manufacturer not behaving as appropriately as it probably should, any insights on that, and whether Burford's got any exposure?
So John Mallow and I co-founded the business together 10 years ago. And we hold equity in the business, and we also invest personally in the private funds. We did, for the first time in our lives, sell some stock because I finally got tired of being told by bankers and advisors that I couldn't preach a diversified model to shareholders and not have one myself. And so we did sell some of our stock. We sold 1/3 of the stock that we have. And at the same time, we signed up for multi-year new employment agreements. So that was a liquidity transaction, and we're strongly committed to continuing on in the business. The Volkswagen question that you raise, so it's a matter of public record that sometimes Burford's cases come into the public eye. Not often, but sometimes, and Volkswagen is one of them. We've provided capital to a law firm that is representing some institutional shareholders associated with the Volkswagen debacle. It's too early in Volkswagen to tell what is going to happen with those cases. You know, the way this all works is when something big like that happens in the litigation world, all sorts of lawyers and all sorts of clients pile into the mix, and they file lawsuits all over the place. And then it takes some considerable time to sort of sort out what the lead lawsuits are going to be. And at the moment, nobody knows outside the US. In the US, that's become clear, but nobody knows in Europe whether the people that we're backing are going to have the lead lawsuit or whether they're not. It's sort of a riskless option for us because we're not putting money behind it until you know that they're in the lead. So we might make some money from that, we might not, but we're unlikely to lose money from it.
Okay. Gentleman here, please.
Oh, hi, me again. I understand, or am I right in thinking that Burford have found a niche in the insurance market you're moving into? And if that's correct, can you tell us any more about it?
So Burford has had a history in the insurance market, and this is something that is applicable in England and some other common law countries, but not in the United States. So as many of you will know, if you sue somebody in England and you're unsuccessful in that lawsuit, you're going to have to pay their legal costs, or at least some of them. There is an insurance market to insure just that risk, the risk of having to pay the other party's adverse costs. And Burford used to have a middle market business of insuring that risk. We've written a significant number of policies, something like 50,000 policies. We bought that business in 2012, and that's been an absolutely spectacular acquisition for us. We're probably going to end up taking 4 or 5 times our money out of that acquisition. But we're not in that business any longer because some regulatory changes that we knew were coming have made that a less appealing business. And so that business is in runoff, although it's still generating some profit for us. We've identified another niche that is fundamentally around group actions, institutional investors, candidly. Because the challenge here is, let's say 10 of you together each go and buy shares in a company, and that company turns out to have been a fraud, and each of you have a lawsuit to bring about that. You're likely, for the sake of efficiency, to bring that lawsuit together, as opposed to each of you going to court separately. But the problem with doing that is that each of you, under the English rules, will be jointly and severally liable for the entire costs of the other side of the case. And so you probably, in an expensive piece of litigation, don't have a large enough position to warrant taking the risk of all of that adverse costs liability. And so we have created a new insurance vehicle where Burford will provide a layer of insurance, and then we've arranged structural reinsurance for it that will allow us to offer insurance coverage in those large dollar circumstances where we are also providing funding to the claim. The reason that we're doing that, though, candidly, is to facilitate the funding, as opposed to because we want to launch ourselves separately into the insurance market. We're going to make more money on the funding than on the insurance, but we can't get the case to go forward because there's this gap in the insurance market.
I had a quick question of my own, complete change of subject. The last bond was dollar denominated.
It was.
Why not sterling like the previous?
So Burford's, when you look at Burford's currency, and there's a slide in there that'll show you the currency split, Burford generates something in the neighborhood of 80% of its revenue from dollar-denominated transactions. And that's not only transactions that are occurring in the United States, it's also because US dollars are the language of lots of international litigation. So, we have a case running right now that is, a fight between a Spanish company and a South American entity. That case is nonetheless denominated in dollars. And so because we consume a lot of dollars, it made sense for us not to have a currency mismatch if we could avoid it. And so we decided to test the market and see if there was appetite in the UK retail bond market for a dollar-denominated product. And sure enough, there was. And so we were very happy to be able, we were the first firm ever to get that done, and we were quite happy to have made that work.
Okay. Question at the front, Peter? For the mic? Oh, sorry, very sorry. Gentleman here, sorry.
Sorry, a couple of quick questions. Do you have any plans for moving from AIM to the main market? And secondly, if you in the future require more capital, will you go down the bond route rather than issuing more share capital?
So the main market question, we decided this year to do an extensive review of the listing and of the sort of the capital options generally. And so we decided that we would ride on the inherent rapaciousness of investment bankers. No insult intended to the MB Capital. And so we brought in 3 separate investment bankers independently, and we had them do a review of the listing and a variety of other questions like that. And all 3 of them came back with the same unanimous set of recommendations, which was do nothing, including don't move to the main market. And I put a lot of faith in that because they all could have made fees from suggesting that we do something. So when a banker tells you not to do something and doesn't make any fees from it, I tend to think that's a fairly reliable set of advice. And the fundamental reason was, we're sitting right now, what did I say, 137th, in the FTSE rankings. Nobody believed that we were going to get incremental liquidity, incremental valuation pickup from moving to the main market. The bonds trade on the main market, and so anyone who is concerned about governance, there's a main market prospectus out there that's been through the UKLA, but the answer is we seem to be doing pretty well as we are. And as to future capital, I think the answer is we're fundamentally opportunistic. Right? We've been issuing bonds because that is a very attractive way to lock in long-term low-cost capital. If interest rates start to go up, then I think everything's on the table.
Okay. I think I know Christopher's time is very tight.
I can do one more if you can do one more, but
Just on the back of the AIM question, which is very well made one. Yeah, just on the back of the AIM question, sometimes institutional investors, funds in particular, are put off just by the definition of it being an AIM. Have you experienced that yourself? Had to explain it to them, or
not really for two reasons really. One is size. So I think the AIM issue is more of an issue when you're considerably smaller. Once you're a multi-billion-dollar market cap, I really don't get a lot of negative feedback about AIM, not only from investors here, but even from international investors. Burford shareholder register has been diversifying to include European and American investors, and they don't seem fazed by it at all. I do think having the bonds traded on the main market is a small benefit in that regard. So, in every bond issue, we've had to go through a UKLA prospectus process for those bonds, and we've got a main market trading security. It just doesn't happen to be the equity. I can't answer the question hypothetically of what would have happened if the only thing we had was AIM-listed equity, but it's not something that I see as being an issue with investors.
Okay, we're going to have to wrap it up there. Thank you all very much.
Thank you all very much for your time and attention. I really appreciate it.